terms of real estate, the median price of a detached home in the Lower Mainland, $760,000, 50.8% higher than the previous year. Obviously, real estate an expensive commodity. What questions should people be asking when it comes to getting the right mortgage?
Well, realistically, there are over a dozen municipalities where real estate is affordable and you can own a home for $200,000, which is an income earner of $40,000 a year can qualify for, and your mortgage payment is less than what the average rent is in the Lower Mainland. So there are lots of opportunities. It's all about the right mortgage strategy.
A lot of factors come into play right now, and one of the big stories over the last summer has been the downgrading of the U.S. credit rating. What has that meant for markets here in Canada, and what has that meant for both variable and fixed rates?
Well, that's a great opportunity for Canadians because that means that rates will remain low for a longer period of time than was suggested just a few weeks back by the Bank of Canada. So what this does is this means that anybody with a mortgage over 3.5% should absolutely be reviewing their mortgage, and this gives you the opportunity, if you were carrying debt outside your mortgage, to really reduce your monthly expenses. And also you can review your mortgage in terms of structuring it for tax efficiency as well.
Every situation is kind of personal, but when you're approaching a mortgage expert to work with you, what are the questions you should ask to make sure they're on par, they're knowledgeable of the entire market and what's going on?
Well, there's 4 essential questions that you absolutely need to ask. The first question is, what are interest rates based on? And there's only one answer for this, and the answer is that variable rate mortgages are based on the Bank of Canada and fixed interest rates are based on the bond market. Now, of course, that's important because if the professional that you're working with doesn't have an understanding or has their eye on the wrong thing, that's going to cost you thousands of dollars. The second question that I always encourage people to ask professionals is, if I take a fixed rate mortgage, I assume that I'm protected for the duration of the term. That's actually not the case because when interest rates go back to more normal levels, there's a possibility that you can have payment shock. So just because you have a fixed rate or what you believe to be the best rate, that doesn't necessarily mean the best option. Thirdly, you need to clearly understand what's the mortgage strategy that you're recommending and why. And the key word included in this should be strategy, because anybody can quote an interest rate, but believe it or not, the lowest interest rate often doesn't mean that you are going to save the most amount of money over the term. And a great example of that is, look how interest rates have decreased since 2008. If your mortgage lender hasn't given you a strategy on how you can optimize the market to maximize your lifestyle and reduce your living expenses, that's not a great thing. Fourthly,
just want to interject, what would you say is a favorable term, especially for those that are going variable? More and more when I talk to people, they're saying variable is the way to go. What's the safest bet that you've seen?
Well, variable is absolutely one of the best options that's out there, especially with the low interest rates and with the right mortgage plan in place. Because with the right mortgage plan in place and the best terms combined with that, you can learn how to optimize the market. So regardless of inflation, you're always going to be ahead of the curve. But that takes consistent planning. So when you're asking your mortgage professional what personal commitment they have, which is the 4th and final question, you need to know what kind of proactive management system they're going to have for your mortgage, so you know how changes are going to affect you in real time. Because if you've had a mortgage that's not being reviewed on a consistent basis, it's costing you money. And even with the variable rate mortgage, if you don't have the right variable, you can actually be extending your amortization